Morrison, and welcome to my latest edition of the Thinking Cap. Today, we're going to take a quick look at the markets. We don't have any USDA right now, but I don't think that's a whole lot of a problem. So let's dig into the markets real quick. We'll do a kind of a cut version of what we would do in the aftermath. Just take a few look at a few charts and see where we're at here as we get towards the end of the month of October. October is an important month because we're setting the harvest prices for our revenue insurance policies, and we're about 2/3 of the way through the month. So what's happening right now? Well, we don't get a USDA harvest progress report, but the trade and the news services continue to compile the numbers from several analysts. The analysts are estimating as of Sunday night that bean harvest is up to 74%, corn harvest at 59%. Both of those are within a couple points of normal, so nothing to talk about here. Kind of steady as she goes, so to speak. We've heard about basis levels in some parts of the Midwest that have actually improved a little bit here as we get into the back end of harvest, which maybe tells people, A, there's a lot of on-farm storage available this fall, and B, the market, the big elevators, terminals, just not getting a lot of grain coming in right now. So kind of interesting considering we've got a record crop that's being harvested. So let's start out looking at corn. The big news yesterday that kind of pushed the corn market lower. The American Petroleum Institute saying that they are now opposed to year-round E15. That goes against an earlier discussion that they had where they were going to be supportive of all of the different fuels. And so this kind of hit the market a little bit yesterday. Not sure exactly what EPA is going to do or the U.S. government's going to do, but the fact that they've kind of taken a different stance was seen as a little bit bearish, I guess, towards potential growth of E15. The big positive right now in corn continues to be exports. Exports have been surprising us now for a few months, continue to be very strong. You can see that the loadings so far early in the year have been the best they've ever been. And part of the reason for that is good demand. Part of the reason for that is lack of bean loadings. And so export elevators are, using their space, using their ability to load a lot of corn right now, and wheat. We'll look at wheat here in just a second. But if you look at export loadings now for the first 7 weeks of the marketing year, the marketing year started on September 1. Now, we are getting these reports because these numbers come directly from the grain elevators, so they don't go through the government. And you can see loadings have been a record high, most we've ever loaded in corn for the first 7 weeks. Some of this is also by rail. Keep in mind, we do rail a lot of grain to Mexico. And so between ship loadings, record pace right now. So don't know if we'll keep that up the rest of the year, but that's a good sign, at least for the corn market. The funds are short corn, continue to be short. Why? Well, record corn crop. Until we see somebody come off of these big yield numbers and put a 1.7 in front of the yield number, if that ever happens, it's going to be difficult to get these funds to go long. And even with strong demand, we're still looking at carry out potentially up around 2 billion bushels, give or take. And so that's what's been the driver here. Despite the strong demand, it's still based, their position is based on the size of the crop. So if you look at the market, markets have gotten pretty quiet, to be honest. And part of that lack of volatility is the government closure and the lack of reports. We're not getting the export numbers that we normally would get that might swing the market a little bit. So that's part of it. Lack of trade talks, maybe a little bit of it as well. Whoops, I'm sorry. Well, the other direction. We've kind of seen this market really shrink. And you look at these moving average lines right here, all of these, the red, the blue, the gold, and the purple, those are the 9, 20, 50, and 100-day moving average. It's pretty remarkable. Here we're in the middle of harvest, record corn crop, yet all of these moving average lines are within a nickel right now. So that is pretty, 3 cents actually. You still have the 200-day long-term moving average still above the market. You've got this huge lid on this market right now, this chart gap from July 5th. I've talked about it for a few months now. That's from 430 to 433. You've got the 200-day moving average just above that. You've got the September peak, which got up into that gap but wasn't able to quite fill it. if we're able to get any kind of a bump here, I still think that, that's our lid on this market. That's where I want to sell it. So anytime between now and December expiration, that's my target, this 430 area. I still think it makes sense. If you're selling March corn instead, or May or July, sell the carry in this market. The carry is still large. So take advantage if you got space at home and we get a rally up to 430 rather than selling December, go sell May corn at 450 or something like that. Earn the carry, lock that in, and be able to make some decent money. The crop insurance price right now, we're settling about 419, something like that. We've only got a few days left to set that. That's down about 11% from our base price back in February, which means if you've got 95% insurance, say with an ECO policy, could see some payments on ECO this year. If you're at 85 RP, then the price drop isn't enough to trigger a loss on its own. You would also have to have an additional bushel loss. So that's kind of where we stand with insurance at the moment. But where do we go from here? You've got a recent low at 409. You've got that big cap up here around 430. I still think that's going to probably hold the market into the December contract expiration. Then we start looking at the March. The indicator lines at the bottom of the page had gotten a little bit toppy maybe at the end of last week, and that was probably part of the reason we saw some selling yesterday. But here we are back up this morning. We're back above the 100-day moving average, 422. Can we push back up to that 430 level, get another dime out of this? I think that'd be awesome. Saw this chart from Darren Fessler on X the other day, comparing this year's March to last year's March. Now, and I did include this in my market report a couple of nights ago. The one reason I would be a little bit leery to get too excited about this chart is that everything is different this year than last year. Last year we had a really tight carry out. We were talking $1.3 billion. This year we're talking $2 billion. Demand was getting strong last year despite the tight stocks, and it's continued to strengthen this year. Don't know if we'll see anything from China, other buyers or not, so that remains to be unseen. But just look at the pattern, how it's been very similar. And we didn't have the summer weather story again this year, second year in a row. So the markets continue to trade, do what they do. Probably overdid themselves early, as they tend to do because of that. And now you've seen the markets bounce back. Now, what could cause this rally into Jan-Feb? It would be fund driven. The funds are still short 100,000 contracts. So if you give them a reason to buy it, then we can get that rally. What's going to cause the rally? Well, at this point, it would probably take a drop in production, because I think we're already throwing the bullish demand news into the market. Now, maybe China buys some corn or something like that, in some sort of a trade deal. That would give this market a boost. But besides anything like that, maybe it is E15. Maybe we get an E15 law go into place or something like that gives us a boost. But it's going to have to take something to get the funds back on the long side of the market. So at the end of the day, I think it's going to be fund driven if we do. All this being said, I'm still holding my stance that I had back in August, September, that I'm not real bearish corn. I don't see a lot of downside risk in this market because I do think this crop's going to get a little smaller. I do think there's some potential for upside. I don't know if it's as much as we had a year ago, given the fact that we had a much smaller carryout. But I do think you can get back up into that, March up into close to 450, 445. I think that that's at least doable. Making that next 20-cent jump, it's going to take something that I don't see here today. Soybeans. What's going on in beans? Well, the big story, of course, has been China, or the lack of China. China did not import a U.S. soybean in the month of September, first time in a long time. You can see where their imports are, though this is just Chinese ag imports for the month of September, also year to date. Beans are running 13% higher in the month of September. They were up 5% for the year, but again, the United States not partaking in that. You can see some of the other Chinese numbers well below year-ago numbers. Imports are down in general across the board for agriculture. So U.S. bean inspections, bean loadings continue to struggle. Most of that because of the lack of China. This is the time of year where typically we ship a lot of beans to China. That's the reason we see this peak right in through here, this October to January window. And at this point, we don't anticipate that happening here this year. Cumulative import or exports, therefore, the lowest we've seen in a long, long, long time, at least well before, probably back to the drought year of 2012 was the last time we had exports this low at this time of the year. The other big story is South America. They are planting the northern states, Mato Grosso, Paraná, are over 50% planted on beans. You can see CONAB's recent report projecting production of beans over 177 million tons this coming year, which would be a new record. I read another guy yesterday saying that he thinks the potential in Brazil is 190 plus. So take that for what it's worth. Of course, you have to have great weather for that to happen. I do have some maps in yesterday's market report that shows where they're at right now, but they don't have any real extreme drought or anything like that at the moment. So things are off to a pretty smooth start, all things considered down there. The big positive story in the United States is the crush, and we've known this for a while. We've been talking about this story for a couple of years. We've got new plants coming online. We've got additional crush capacity coming online. So crush is making up for some of our loss in export demand. It's not making up for all of it. So net, we need more domestic crush, but that is the positive story. The other sleeper story, I think, in all of this is that this crush, we're crushing beans now for the oil. We've got a lot of meal supply. We've got cheap meal, and we're starting to see meal exports start to pick up a little bit. So even if whole bean exports lag a little bit, you may see us be able to sell meal to some countries, maybe into Central America, maybe into Europe. We're starting to see a little bit of that happen, and that's where the potential sleeper story, I think, is in soybeans as we go forward. So the funds estimated to be right now just a little bit on the short side of zero, back and forth over the last several months, depending on which week we think we're going to get a deal with China, and the next week we don't. And now the farther we go into harvest, the less likely we are that it's going to make an impact this year. There's a lot of stories right now. Does China need to buy a U.S. bean? And I could make a strong argument that based on their current path of buying and based on what South American stocks are, they probably don't have to buy a U.S. bean this year. They could probably get by on their government stocks, selling stuff out of government stocks to crushers. Crushing margins right now, I'm reading, are negative. So they're not in a big hurry to get this thing done, at least from a standpoint of soybeans. And so, I know we all want that to happen. We want that extra demand, but we have to, I think, face that we're the residual supplier of beans to China, and they're going to continue to buy South American beans when they can, if they're cheaper, and for the most part they are. And a lot of that reason that U.S. beans are not cheaper is because of the domestic demand. You got this crush demand now domestically that's using more beans. And so, we have to kind of be careful what we want. But right now, we're seeing that big shift really take place right before our eyes. So the bean market, the volatility's kind of shrunk in beans as well. Part of that because of the government shutdown, part of that because of the lack of reports. However, you look at the trend of the month of October, and we're 40 cents off the low here this morning. We are pushing the top side of this little downtrend line that started back in August. So can you nudge through that? We had already filled the July 5th gap on beans. We did that a long time ago, so we're not really focusing on it. If you want an upside target in beans, certainly closing above this downtrend would be a big positive. We're kind of in this pennant formation right now, and if we're to do that, then this double top at 1074 to me would be the logical target to the upside. So maybe 1065 to 1070 be a good place to have an offer in if you had beans going into the bin. Technical indicators, RSI at 58, stochastics kind of nudging up into overbought territory. Not yet, but if you add another 20, 30 cents onto this market, certainly they would be very overbought. So I think that's a good target of mine. From an insurance perspective, the price we're setting right now is only down a little more than 3% from where our base price was back in February. So I would anticipate very few revenue losses paid this year. You'd have to have a loss in yield in addition to this drop in price in order to trigger a payment, which I don't know how many people are going to have yield losses in beans. So kind of where we're at. Now, can beans rally much into the winter? I think that's going to be up to South America. What's the crop look like down there? Certainly, you would get funds to buy beans if we get a trade deal done with China. If China says, yeah, we're going to take X amount of beans for December, January shipments, something like that's still possible. So that would be a potential upside driver. But I do think potentially the biggest negative is Brazil. And if they do raise these, get these record crop planted, and if it does produce well, then I think you're going to continue to see some pressure on into next year. So the export side of the business, is not growing. We know that. We need to continue to see the growth domestically. Now, trend-wise, saw this yesterday. Peak Trading shared this on X that, as you go into the winter months, into November, December, we tend to see a little bit of a bump in beans. So maybe you do continue to see that little upside. Again, I think that 1065, 1070 area would be a heck of a target to be able to sell November beans. And if you can sell the carry, if you got beans in the bin, look to January, March, something like that, maybe be able to sell $11 futures. Might be a heck of a deal to get that done. I mentioned South America a minute ago, the planting pace, they're going along pretty nicely right now. Mato Grosso pushing up to 45% or so. Overall, 20+% of the Brazilian bean crop has been planted. They have a little bit of dryness up here into the central eastern part of the country. For the most part, though, not a lot of too wet, too dry. The 7-day forecast does bring some pretty good rains into eastern Argentina, into Uruguay, Rio Grande do Sul, Paraguay, even up here to Mato Grosso. So I don't see a whole lot here to get too excited on if you're bullish the bean market. And then looking at the next 30 days, yeah, maybe. You got some good rains up here into Brazil, not so much down south. So that might be a developing story. We'll watch eastern Argentina and southern Brazil as we go forward. Switching to wheat, wheat exports. We'll start with the good. Wheat exports have been pretty good this fall. You look at shipments here, September, October. We've had some very strong weeks relative to what we've seen over the past several years. So that's been the positive. Wheat shipments so far, the first 20 weeks of the marketing year, which started June 1, the fastest pace we've seen in a long time. The negative here is the United States share of the global wheat market. And even though we're seeing a little bump this year, we're still really low. And so we need wheat exports if we're going to see a wheat rally. And if you look at the price of wheat right now, we'll look at the price chart here in a second, but it kind of resembles this chart that exports continue to drop. So unless production has a problem, it's really difficult to see wheat rally. And that's where we're at. We're at a situation where we've got good production, where we've got exports that are just kind of wandering around down at some really low levels. And until you see a reduction in supply, it doesn't look like we're likely to see a big rally in wheat. So planted acres this fall, probably going to be a big deal. How does the wheat crop get started? Certainly that's going to be a big deal as well. We made a new low here just a week or so ago, down below $5 in Chicago wheat. We're trading above it here this morning. We are above the 9-day moving average. We haven't been above the 20-day since back in September. We've got this double top at 535 right now, which sits just about where the 100-day moving average is. That looks to me like a heck of a target if you got wheat in the bin. Kansas City is going to be very similar as well. So that might be something to consider in wheat. And then finally in cotton, this chart I saw yesterday, and I've talked about this the last couple of aftermaths, but the China deal with cotton might be as important as it is in soybeans, even though we're not talking about as many total dollars. But when you're talking per acre in the United States, the lack of exports to China is still a huge deal. And the percentage of U.S. cotton exports going to China this year, we're only talking 5 or 6% compared to more than 40% a year ago. So we're finding some other homes for cotton, Southeast Asia, Turkey, the rest of the world. But boy, we'd like to have that Chinese market. And without that there, it's just going to be difficult, I think, to get this cotton market to get up and run. And that's what the funds have been trading for a long time now. They've been short for more than a year. You look at the red line. A year ago in August, they were short cotton. You go all the way back to the yellow, even in about April, May of 2023 is when they went short the cotton market. We're short all of 24, all of 25, and now here we are still late 25, and then the funds are short about 60,000 contracts of cotton. So it's driven by demand or lack thereof, and until we see something change, especially with a trade deal, it doesn't look like we're going to have much upside. And so that's what the market knows. And we're continuing in this downward slope. We had our insurance price back in the spring at 69 cents. You can see the highs each time we rally are continuing to be lower. So we've had lower highs, we've had lower lows each time. The channel has been working down, and then we broke out the downside of the channel here at the beginning of October and made a new low here in October at 62.71. The insurance harvest price running at 64 cents, down about 6.6%. So that's not on its own enough to trigger a revenue loss. We probably have to have a bushel or a yield loss as well. And the only positive story I can say is this morning we're trading above the 9-day moving average, but we haven't been above the 20-day in about a month now. So as far as an upside target, you got the 100-day, this down slope, everything up around 66, 67 cents. If you've got cotton going into storage here this fall, that'd probably be a good target to be looking at this point, unless we see a trade deal done. And if a trade deal gets done, maybe that starts to open the top side of this thing up. But I think as an initial trading target, probably looking at that 66.5 to 67 cents as a target. So we always try to look at some of the other pieces of the revenue pie. When you look at insurance, we've talked about this already on some of these, but corn, we're about 2/3 of the way through this month and setting harvest prices for the bulk of the country. Corn running about 11% down, same with sorghum. Beans about 3.5%. Rice running down about 23%. So I anticipate we're going to see a lot of revenue payments on rice this year. Cotton only 6 to 7%. Sunflowers and peanuts, which base a lot of their prices on bean oil. Bean oil has had a good year this year, and thus prices higher. So we would have to have a yield loss in those crops in order to trigger a payment. But from a revenue standpoint, rice, corn, probably the two crops that could trigger losses this year. So looking ahead to 2026, not very far away. A couple of comments that I saw here on X the last couple of days. Number one is that S&P Global put out some initial planted acreage numbers for next year already. They've got corn at 96 million, which is down about 2.5 million from this past year. They got bean acres up about 2 million acres to 83 million, and they've got wheat acres down about 1 million to 44.4 million acres. So we'll see what happens eventually. I do agree with that trend that we ought to see more beans, less corn, mainly just due to crop rotations we've seen over the last 3 years back and forth. Heavy corn, heavy beans. This year was heavy corn. I would think we're going to see a switch back to a lot of those acres going to beans next year. I don't anticipate anybody that's in a 50-50 rotation doing anything wild and crazy. But Josh Linville did share this as well, showing the change in fertilizer prices, which could eventually have an impact on some crops here in the country. But he mentions from 2 years ago at the same time, corn price down 16%, while you've got, some of the urea, UAN prices running sharply higher, DAP running higher. I would think that we're going to see a lot of people do some soil testing this fall and figure out, do we really, really, really need some of this dry fertilizer, especially DAP, with the price up so much. So we'll see what happens. But I do think we're looking at lower corn acres, more beans next year. Question is, how big will that shift be, and how much of that is just rotational? So one thing I did want to show you is this tool that we have, this profitability matrix. I would encourage you, if you're a producer, talk to your agent and they can pull this up, show it to you. It's a one-page tool, pretty slick to be able to look at your risk management all on one page. But we can look at your crop insurance here. If you buy an 80% RP policy, SCO, ECO. One thing about these county products, they're going to be subsidized at 80% for next year. So they're going to be pretty cheap to be able to get your coverage up to 95%. So you can put in your cost of your insurance, put in your other expenses for your entire operation, put in a forward sale if you're going to make one for next year. You can also put in an estimated PLC or ARC payment. And if you start looking at the math, and we'll talk about this in some subsequent videos, but right now, if prices stay where we're at today, we're looking at a decent payment for corn and PLC, beans, other crops as well. You can plug that in. You can leave it out if you just want to look at that as potential bonus money down the road, whichever way you want to look at it. But then you can see with yield and price what your profitability looks like. So it's a real simple tool, not too many things to plug in, but shows you where you're at for this coming year. And if your costs are different, then certainly your numbers are going to be different as well. So I would encourage you to take a look at that tool. It's on our agent portal if you want to find it. So with that, thanks for listening to this edition of the Thinking Cap. Hope you continue to have a safe end of your harvest season, and we'll talk to you again really soon.